Hello, dividend growth investors. It's Colby, the DGI Crab, coming to you on a Monday, late afternoon, early evening. Just a reminder to everyone out there that with the holiday weekend coming up, you're going to have a investing time frame for the week that is cut in half. The markets are going to be closed typically by noon. Eastern time, if I'm not mistaken, on Wednesday this week. And the markets will be closed Thursday and Friday for Thanksgiving weekend. So any weekly investments that you might be making, got to remember to get those done early on Wednesday at the latest, or else you're going to be locked out until the following Monday. So I usually go over the DGI Crab allocation strategy and the Four Tiers Spreadsheet on Friday, and I'm going to do that this week on Wednesday. But I thought since there's a very short week that we've got here, it wouldn't be a bad idea just to do a quick check-in on the four tiers, see where the value lies so you can make your decisions a little bit early this week on where you want to allocate that capital to get that passive income stream built up and stronger than ever. I have the DGI Crab allocation strategy here on the screen, just for those of you that are not familiar with it. And this is a passive income building channel where we focus on the most important metric, in my opinion, for a dividend growth investor, and that is the age and timeline of the investor. And just a reminder, I'm not a professional financial advisor, so the content of this channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing any of your hard-earned money. So let's just take a quick look here at the four-tier spreadsheet, where we start off with the tier 1 investors aged 18 to 30 years old. Certainly still looking like Nike is going to be the primary value there on the list for the tier 1. And I get my valuation metric by comparing the 4-year average yield of the stock with what it's yielding current day. Nike yielding 2% or better certainly looks very inviting to me. And it has been down in the mid 70s. It had a pretty nice day today here on Monday, recovering back up, pushing $80 a share. But I think even at $90 a share, Nike still looks to be a little bit cheap to me. So you could definitely do a lot worse than Nike. You might also keep an eye on Nordson. Nordson is pushing its way up into the buy zone once again. Not quite there just yet, but this dividend king is certainly one that has a very rapid dividend growth rate year over year, which is exactly what you're looking for in this tier. For the tier 2, age 31 to 41-year-old investors, still going to be all about Hershey and Target. Target, after reporting a bad quarter of earnings last week, tumbled all the way down to $120. It has recovered up to $130 pretty rapidly. And that's generally what happens. Bad quarter comes out, stock takes an immediate hit, doesn't always immediately recover, but when you're looking to add some value to your portfolio, you're kind of counting on some bad news to happen at some point in time or another so you can add to your position at the best possible deal. I think Target down here, even at $130, still looks to be quite undervalued. It's been a tough year for retail, and Target is certainly has not been immune to that. But they have increased that dividend for well over 50 consecutive years as a dividend king. It's not the first bad quarter that Target has reported over the last 50 plus years. I think they're going to rebound from that and do that just fine. Not sure how long they're going to stay down here in the super buy zone category, but with Hershey and with Target, you're getting a couple of very recognizable brands that I think are going to have a nice recovery story at some point in time. You just have to be patient for it. And then McCormick is getting oh so close to that buy zone. It stayed kind of flat here today, hovering in the $77 range. Still want it to get a little bit cheaper than that. But after that dividend increase that they announced last week, they're up to $1.80 per share per year, and extremely consistent with their dividend increases. So if I could get that yield up just a little bit more, I'd certainly be happy with that. Tier 3, 42 to 53-year-old investors, getting a little bit higher yield as we move up into the tiers and slightly lower growth rate. But we're never going to throw growth rate completely out the window. Archer Daniels Midland continues to be the most undervalued stock in this tier. So far this week, nothing has changed as far as that goes. Hormel Foods had fallen below $30 a share. They've climbed all the way back up above 31, which is definitely encouraging, but it's certainly been a rough year for Hormel. I actually asked Ryan Williams in his live stream last Friday. If you haven't watched that, go check that out. Ryan always posts those live stream videos shortly after he goes live, and he was actually kind enough to answer my question on Hormel and spent a little bit of time in that video doing a deeper dive on the numbers. Certainly came up with some red flags, don't get me wrong, but this is another one that I'm going to be relying on their long history of 57 plus years of consecutive dividend increases to continue on and eventually recover and get out of that slump. But shout out to Ryan, and definitely go check out that video from last Friday if you want to see him go into further detail on Hormel. Let's see. And then Pepsi remains right in my buy zone. This is one of my top 10 favorite stocks. And of that separate list, Pepsi is the most undervalued one there right now. And I am certainly pretty happy to add to my Pepsi position at 163 per share. It's just one of those stocks that typically doesn't get up into this 30% or higher valuation for me very often. Very high quality company, very steady player. And anytime I'm able to add to a position like this one at a reasonable valuation, I'm pretty happy to do so. You see the 4-year average yield for Pepsi is 2.75, currently yielding 3.32%. So certainly a good opportunity to get a good high starting yield on Pepsi. And let's see. And then Johnson & Johnson, it was kind of knocking on the door of that 20% last Friday. It ticked up just a little bit today, but I'm certainly keeping my eye on J&J. I'd like this to get down to about 151, 150 before I'd be adding any more onto it. We'll just have to see how it goes, but I'm certainly keeping a close eye on that one going into tomorrow. And then for the Tier 4 investors age 54 and up, we're definitely looking for higher starting yield. Still keep your eye on Realty Income. It's not quite cheap enough for me. I'd like to see that yield up above 6% before I'd start piling any additional money into it. But certainly if you're looking for a monthly payer and you want some exposure to real estate, Realty Income is certainly one of the absolute blue bloods in the real estate investment trust space. And then finally, that separate tab I keep just for the top 10 stocks, and this is just my personal top 10 favorites. Like I said, Pepsi's the number one value on this. When I get that 20% or higher, I go ahead and purchase any of these if I can get them. And then Johnson & Johnson's close, and the rest, just still not quite there. As you can see with this group of very high quality stocks, they just don't go on sale all that often. And really, even like with Microsoft, if I could get Microsoft above just the zero mark, if I could get that just yielding like 5% higher, it's just been such a powerhouse that I might even add to it at that point in time. So definitely have a few here that are pretty close. But outside of Pepsi, I'm not racing out to add any of these just now, because I do still think that there's better value and pretty similar quality to be had in the other tiers. So in summary, for Tier 1, Nike's my primary ad in that category. In Tier 2, Hershey and Target. And Tier 3, Archer Daniels Midland, Hormel, and Pepsi are probably my favorites from there. And if you don't like any of these deals, you could always just add money into high quality ETFs. So that way you get the automatic diversification and you don't have to worry about keeping track of what the individual companies are doing, especially if you don't agree with my metrics and my valuations where I think that the bargains lie. You don't even have to listen to me. You could just add a high quality ETF like VIG, SCHD, VYM, or even the S&P 500. A lot of good options out there. So certainly not a bad choice to do so, especially on a short week. If you don't want the hassle of keeping track of the individual companies, just go lean heavy into the ETFs for the week and worry more about the Thanksgiving holiday and getting ready for that. And if any of you all are traveling out there, I hope that you're going to travel safe this weekend. Definitely going to have more DGI Crab content coming to you tomorrow. We're going to do an episode of the great ETF race and talk ETFs a little bit more specifically. And then on Wednesday, we're going to come right back here to the spreadsheet to see where we are at the end of the week, and we'll have a nice long 4-day weekend to strategize and make a plan for the following Monday. So thanks for tuning in, everybody. Email me any questions that you have at dgicrab@yahoo.com. I'm always happy to do video content based on any suggestions that you have or any questions that you want to have answered. And as always, there are links in the description below where I go through each of the 4 tiers in an individual video and break down each of the stocks and exactly why they made the final cut and why I put them in the category that I put them in. Once again, thank you so much for tuning in, and I will see you on the next one. Keep investing.